Well, let's welcome in Manishi Raychaudhuri, who's with us. He's Chief Executive Officer at Emmer Capital Partners. Manishi, good to have you with us here on the program. Thank you. Just a quick word, Manishi, on the earnings season that we've seen so far. If you've compiled and looked at the entire stack which has come until now, and how does it compare to your expectations, and what does it mean? I mean, very soon, if we've not already done it, many have already done it, you start looking at F527 numbers. Go on, Manishi.
Right. I mean, we're still in the, looking at the first quarter of FY26. So by the time we start looking at FY27, it'll possibly be towards the end of this year, end of this calendar year. Now, the earnings season has been, mixed at best. So if you look at the large banks, not all of them. So Axis Bank was a disappointment because of, the asset quality issue. HDFC and ICICI were okay. IT services, on the other hand, were a bit disappointing. One would expect them to be so if the US and the entire Western Hemisphere are going through an uncertainty. So, at this point, it's still very early stage, but at this point, the earnings season is mixed at best. What is perhaps more important is the earnings estimate trajectory. And this is the point I've been harping on, on your channel, on several other media interactions. Earnings estimates for India, after a brief interregnum, after a brief recovery, I think around March, April, they're again on their way down. And this is happening across all sectors. It's happening across even those companies which have reported reasonably better results. It's happening across financials, across IT, across consumer discretionaries, across industrials. That is, a bit scary, especially for a market which is still trading at premium valuations, notwithstanding the correction that we have had over past months. So that is the key issue that I, and I'm sure many other market participants, would be watching for the foreseeable time horizon.
All right. Manishi, hi, good morning. Great to have you on. Food delivery and quick commerce. I mean, it's such a strong debate, and all those who remain believers in Zomato, when these companies, most of these companies came out and said, right, that we're expanding our dark stores, there's going to be cash burn. But those who remain believers, they're being rewarded today. But what do you think? I mean, is this just one quarter? Should we be cautious? Because a lot of the broker notes this morning are saying the worst is over. I mean, market share gains are great. They have a very strong going out business that they're building as well. So, gets a little heady when you have this kind of commentary. So what's your view?
In the short term, they do look good, in these quick commerce and food delivery companies. But if I draw, from the experience in China, these food delivery companies, despite skyrocketing growth, skyrocketing top line and volume growth, the stock prices have, kind of collapsed. I wouldn't say collapsed, but they have underperformed significantly simply because of one reason. And that's unbelievable degree of competition between the likes of Meituan and JD, and even Alibaba has its own food delivery outfit right now. So this is something we have to be careful about. As of now, India is kind of a benign oligopoly, and we haven't seen that crazy market capturing price war. But, it is something, if I take some kind of a leaf out of a larger market, which is China, and which I'm much closer to, this is something we have to be very careful about.
Manishi, but what's your take on
And sorry, just to complete that point, Nigel, once again, completely take your point on competitive intensity, which is why I think we need to see if this is the last of it or not. On what about valuations, Manishi? Because Mangalam, our colleague, was just telling us that on 1 year forward earnings, Zomato is trading at over 70 times. So it's not like you're getting it at a rock bottom valuation either. So again, just give us the valuation comparisons as well to a market like China.
That's a great point. That's a great point.
Yeah.
And think of an international investor sitting in London or New York or Hong Kong who has the entire canvas to choose from. So he can choose from Zomato or Swiggy trading at maybe 60, 70 times P multiple 1 year forward, or Meituan, or any of the others like JD. I mean, these are not pure, pure food delivery. Meituan is, but these are trading at high teens. So it's a striking comparison that an investor has to choose from. And that is certainly a second point, which I'm sure would make the investor base a bit careful about these companies. Now, of course, these are in different stages of their life cycle. So Meituan started somewhere around 7 to 8 years ago, and it has reached a degree of maturity. So the growth is not really as high as that of Swiggy or Zomato. But it's at some point of time, even the Indian quick commerce companies would reach that stage. And the question to ask is, how far away are we from that moderate growth stage? As far as the Indian companies are concerned.
All right. Hi, Manishi. Good morning. Good to see you, Win. Well, the Indian markets actually have been resilient, right? We had geopolitical issues. You've had Trump's tantrums or tariffs, whatever you'd like to call it. You have the regulator that's tightening the screws and volumes are down. And still we're at around 25,000. What's your sense, from year on, in the next 12 months or so? Could the Nifty be much higher from year on? Are we entering the next phase of the up move? Because the RBI as well has solely focused on growth. Inflation's under control. That's another booster shot. Your take.
Right. So let me break down that question into 3 or 4 different parts. First, India is in a very curious position right now. If you look at the macroeconomic fundamentals, they're actually quite good. You have declining fiscal deficit, you have a sharply declining current account deficit, which is hardly about 1% or so. You have sharply declining inflation. CPI came out at 2.1%. So these markers of macroeconomic stability, they're actually doing fine. The problem is with the micro, where earnings growth is disappointing. Almost every quarter, almost every month, earnings estimates are being brought down. So what we thought would be a 17 to 18% earnings growth year, fiscal 26 and 27, now looks like it'll be about a 14 to 15%, maybe even a percentage point lower. So this is what the investors are grappling with. So the real enthusiasm for India would really come back when we are able to put this period of earnings growth estimates being whittled down, when we're able to put this period behind us. When would that happen? That's $1 million question, possibly late this year, when the impact of government capex increasing gets felt again among the industrial companies, when the impact of RBI's jumbo rate cut and possibly 1 or 2 more going forward begins to be felt among the consumers. It usually takes about a couple of quarters or more. So I'm thinking about the last quarter of this calendar year when the earnings estimates would bottom out and then begin to increase again. And now I'll come back to your first point. On an isolated basis, India looks like very resilient. Yes, it has held on to that, about 24,500 to 25,000 for the Nifty, somewhere around 80 to 82,000 for sensex. It has increased. It has appreciated hardly about 2.5 to 3% this year. Look at Asia ex Japan. MSCI Asia ex Japan is up 14%. If you simply bought an ETF on MSCI Asia ex Japan, which is almost a zero-cost ETF, you would have made 14% in 6 months, and that's stupendous returns. So in comparison to its Asian markets, India hasn't done really all that well. And, I think that is something that we have to look forward to.
Like they say, gains beget gains, success, brings more success, right? So eventually, once we get our mojo back, then everyone will come. That's what's happened in the past as well. But we'll see. Earnings have to pick up. Take that point, Manishi. Great conversation as always. Thank you so much for joining in. And we look forward to the next one. Quick pit stop to check the market before we get to our